You know what? I stumbled across something interesting the other day. While everyone's been chasing the latest AI stocks and throwing money at whatever Elon Musk tweets about, I found a stock that Wall Street analysts are quietly rating as a buy, and it's trading under $50. And I'm talking about Truist Financial, TFC. Now, I know what you're thinking. A bank stock? Really? That's what you're excited about? But hear me out, because the numbers tell a story that most retail investors are completely missing. Here's what caught my attention. TFC currently has an analyst consensus rating of buy with a 12-month price target of $50, and the stock is sitting around $45 right now. That's a potential 10% upside right there. But that's not even the interesting part. Let me take you back to October 17th, 2025. Truist reported its fiscal Q3 earnings, with net income available to common shareholders reaching $1.3 billion, or $1.04 per diluted share. They beat analyst expectations. The company's taxable equivalent net interest income for the quarter rose 1.2%, or $45 million compared to the previous quarter. But what really got my attention was what happened next. TD Cowen upgraded the stock from hold to buy on October 21st, raising their price target to $55 from $48. That's not a minor adjustment. That's a firm saying, "We were wrong, this is actually a good opportunity." Now, I started digging into why this stock might be undervalued. And here's where it gets really interesting. The company recently appointed Chris Jackson to lead its new institutional capital group and brought in Pascal Belot as Chief AI and Data Officer. They're making strategic moves into private equity and artificial intelligence. Not exactly what you'd expect from a traditional regional bank. Think about it. While everyone's paying premium prices for pure-play AI companies, Truist is quietly integrating AI into its operations without the sky-high valuation. They're also expanding into middle-market private equity, which is where serious money gets made in the financial world. The fundamentals actually look solid, too. The company has a debt-to-equity ratio of 0.70, a PE ratio of 12.22, and they're offering a dividend. For context, that PE ratio is incredibly reasonable compared to the broader market. You're not paying for hype here, you're paying for actual earnings. And speaking of dividends, they recently announced a quarterly dividend of 52 cents, which represents a $2.08 dividend on an annualized basis, and a dividend yield of 4.6%. So while you're waiting for the stock to appreciate, you're getting paid nearly 5% per year just to hold it. Now, I'm not going to sit here and tell you this is a guaranteed winner. No stock is. But what I found fascinating is that institutional investors appear to be warming up to the bank's long-term strategy following the better-than-expected quarter. The smart money is starting to pay attention. Here's what really matters, though. Based on analysts' future growth expectations, the stock's fair value is placed closer to $50.55. That suggests there's still room to run from current levels. The stock has been on a bit of a recovery path, too. Over the past year, it's delivered a total shareholder return of 1.46%, and over 3 years, it's returned over 13%. Not explosive, but steady, and sometimes steady wins the race. What's the thesis here? Well, regional banks like Truist got absolutely hammered during the 2023 banking crisis when Silicon Valley Bank and others collapsed. Investor sentiment toward regional banks has been terrible, but Truist weathered that storm. They've cleaned up their balance sheet, they're investing in technology, and they're diversifying their revenue streams. The market seems to be slowly realizing that not all regional banks are created equal. Truist has a strong footprint in the southeastern and mid-Atlantic United States, some of the fastest-growing regions in the country. They're positioned in markets where people are actually moving to, not away from. Now, let me be clear about the risks. Banking stocks are sensitive to interest rates. The Federal Reserve's policies will absolutely impact the stock. If rates drop too quickly, net interest margins could compress. That's something to watch. Also, we're potentially heading into economic uncertainty. Banks are cyclical. When the economy struggles, loan defaults go up, and that hits bank profits. You need to be comfortable with that risk. But here's my take. The stock is trading at what appears to be a reasonable valuation. Analysts who cover this company professionally are saying it's undervalued. The company is making smart strategic moves, and you're getting paid to wait with a nearly 5% dividend yield. Is this going to double overnight? Absolutely not. But could it grind higher to $50, $55, maybe $60 over the next year or two while paying you dividends? The probability seems decent based on what I'm seeing. This is the kind of opportunity that doesn't make headlines. There's no viral tweet about it. No one's making TikTok videos dancing about bank stocks. And maybe that's exactly why it's interesting. While everyone else is chasing the next big thing, sometimes the real money is made in the boring, overlooked corners of the market. Do your own research. Look at the financials yourself. Decide if this fits your investment strategy and risk tolerance. But don't ignore something just because it's not exciting. Sometimes the best investments are the ones nobody's talking about. That's what I found. A $45 stock that analysts think should be worth $50 or more, with a 4.6% dividend, solid fundamentals, and strategic moves that nobody seems to be paying attention to. Wall Street might not want you to know about it, but now you do.